Have no fear, the Fed will save the day. But if the Fed is reducing its balance sheet, isn't that the exact opposite? What would happen if the Fed delivered on its promises and didn't print more money? Well, you came here for the truth, so let me unveil that for you. Today we are going to look at various issues, but I want to begin with share buybacks. Let's begin with this chart on the left-hand side. You can see the share buybacks have increased to a record high. Never before has this much money been used by the companies to buy back their own shares. Since the financial crisis, we have seen the rise in share buybacks taking place. You will see throughout 2018, it's going to break more and more records. There's no doubt about it. This right here tells me one thing, because people think of it one way or the other. When I look at share buybacks, I just want to know one thing. How does this affect the stock's price? And of course, it pushes it higher. So when the stocks are being pushed higher by the share buybacks, the retail investors, the little fish, they come in and they sort of chase the wave. So in doing so, that continues this cycle. Okay? So keep that thought in mind. On the right-hand side, top issuers by foreign cash accounted for 2/3 of the increase in share buybacks in the first quarter. These companies are sitting on big piles of cash, and so many of them have engaged in mass quantities of share buybacks. There are, a whole bunch of different breakdowns, what they could do with their cash, whether it's dividends or share buybacks or anything else. But here we have record amounts of share buybacks in 2018. Now, just very quickly, we're looking at high-grade leverage on the left-hand side. That's everything on the right-hand side, excluding the energy, metals, and utilities. Either way you look at it, we are having incredibly high levels of leverage. There's no doubt in this system right now that we are over leveraged in every respect. And whether we're looking at this, whether we are looking at just the average individual leveraging up as much as possible. I have heard many stories locally in Toronto where people are using one home as collateral for the second home, use the second home as collateral for the third home, and so on. And that's not going to end well. That is not going to end well. And it's a simple matter of fact that this is happening to many people. They're doing this, and they're doing the same mistakes that have happened previously, and we don't learn from those previous events. All right. Looking at this here, you can also see the fact that we have surpassed not only the financial crisis, but also the dot-com boom and bust. This here shows us the volatility that we've experienced. Volatility is interesting because, number one, we know that the Federal Reserve admitted that they short volatility. Okay, we have that documented. It's on their own website. So we know that it is a fact. This here shows us two important things. Number one, long periods of low volatility end in sudden sharp spurts of high volatility. So everything is calm, and then suddenly it's not. We saw that with everybody shorting the volatility index, and it was going lower and lower and lower. But in an instant, that flipped and became extremely high volatility historically. Looking at this, the periods of high volatility are of short duration and in tightly grouped clusters with wild turbulence. So it's low for a long period of time. Then we have this really high spike, and then it comes back down because they continue that short process. This is something that I've noted here. I've talked about it on the channel. I just think it's interesting to see the way that it goes, where it's so high, the world is going crazy, and then, everything's fine. The VIX is not a good indicator of volatility. There's no doubt about that. When real new bank credit falls below 1%, recession follows. You could see that in these particular instances, all but one, we have seen this as being an indicator. Happened right here in 2008 timeframe. We saw that dot-com boom timeframe. We saw that back in the 80s. It's countless events that have occurred. And of course, we're right there right now. Does that mean that it's going to necessarily collapse right away? No, of course not. But here we are. I'm actually interested to see the negative comments that are always persisting on this channel. But anyway, when you look at this right here, it's just one more indicator. And every time I get one of these indicators, I want to show it to you. I want to bring it to you so that we can reference them later as time goes on if we start to dip below. We're right there, right at the edge. So we'll see how it progresses. Now, here, Morgan Stanley has this chart, and they've had this tricky handoff. And so they go through this list here talking about, inflation indicators, looking at the market, looking at all this. At the very bottom, they have what I've always been talking about. We go from growing central bank balance sheets to shrinking central bank balance sheets in the third quarter of 2018. The market is not prepared for this. The market cannot sustain this. So I'm interested to see how it all goes. But many people have 7 shares of Amazon that they are protecting. So they have to be concerned about it. Fed funds below the neutral rate, okay? And then the Fed funds at above the neutral rate, again, third quarter 2018. Rising US estimates go to peak in US estimates, again, third quarter. And so they have their own models here. Fourth quarter of 2018, perhaps. All I know is that the second half of 2018 is going to be the real test. I don't know if it's going to collapse. I don't know what's going to happen here in the second half of 2018. But I did poll the Money GPS subscribers, and I'm glad I got so many responses from that. At the time of this recording, about 2,000 people have already responded. And what I have found is many people believe second half of 2018. I don't know what's going to happen, but I do know that in this time frame, we have a test. We have a big test that is in front of us. If they can sustain second half of the year with increasing interest rates, with decreasing the central bank balance sheets globally, we have a perhaps more strong market than we initially thought. But that's going to be the big test. Can they increase interest rates? Right now, we're historically ridiculously low. It's a joke where interest rates are. And despite all that, they continue on with their programs. Let's just, let's make it a joke. Why not, right? Well, we've seen the FANG stocks rising to new and new highs. That is very, very clear. But you can see this, the financial sector itself, taking a look here, in January, we had the peak. The market had been rising and rising and rising here. This is financial specifically. And then we had this effect. What I would note from this period here is that it reminds me similar to what happened with the the financial crisis, because the financials were rising and then the housing crisis started and you had some issues there. You had issues with the subprime. That started getting into the lenders. So then financials started to peak. They started to come down. Then it started to get in that contagion to all other industries, but tech was the last one. Tech was the last one to rise, and then we saw that, of course, tumble down. I'd be interested to see what happens this time around. Was that the peak in this bull market? I don't know. I'm going to follow it. I think the Federal Reserve will allow it to fall a little bit before they engage in a full program of QE4. I don't think they will just, one day just decide that. I think they'll let the markets fall quite a bit before that happens. So I'd be interested to see where this goes. And then I just wanted to touch on a couple more things before I end off here. Borrowing binge over the last decade has been led by emerging markets. China alone has accounted for 43% of the increase in global debt since 2007, or $21 trillion. The entire stock market is reliant on China's continuous expansion. We need China to continue to expand into building more buildings, building more empty ghost cities. They need to be able to have more debt, more leverage, and this system can contain it. $21 trillion for a country like China is massive. It's massive. And so whether or not this will continue, I don't know, but it seems like they are. It seems like they're trying to continue that debt binge. They're no different, of course, than other countries. They're all doing it. Now, this right here is this particular Chinese premier. And what we can note with this individual is that he once told a US diplomat that China's GDP was man-made. That's a quote. To track the growth, he preferred to look at change in bank lending, rail freight, and electricity consumption. And what we note from this is that we have seen a decrease since the financial crisis. That means in terms of like if we were to replace this with the GDP, we could see GDP declining. And of course, we do see GDP declining. So in both ways, we are seeing this growth diminishing in China. Growth is diminishing everywhere as well. However, this is specifically China. The engine that never stops, right? The engine that never stops, and here we see it declining. Okay, last but not least, China's residential plus commercial plus office construction starts. What I can see here is that year-over-year growth has been declining. I don't know where that's going to head, but definitely over the last few years, that has been slowing down. So we'll see how China responds to this. They have been relaxing their lending standards. They have definitely been printing money through the PBOC. They've been engaging in every sort of stimulus measure possible, and still that growth is slowing down because real growth has a lot of power behind it. So we'll definitely be keeping our eye on this. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel. I do appreciate that very much. Last but not least, if you want that real financial education that was not taught in your school, then these books are what you need. The first book, The Money GPS, is about the 4 asset classes and how to profit from them. My second book, Global Economic Collapse, touches on familiar subjects, but I also get into earning income, reducing your monthly expenses, becoming self-sufficient, and so much more. So I definitely do think that these books would help everybody. If you don't know anything about the financial system, you can read these books and learn. I've had people from all ages, from all over the world, read these books and learn a hell of a lot. And it truly makes me happy to know that, to hear from all the people. So if you want to check them out, there are links in the description. Just click on there to bring you over to Amazon, and you can flip through the pages of the books for yourself. Take care.